US stocks are down again as the White House points out total tariffs on China actually add up to 145%, not 125%. So gold jumps to a record high. China is set to cut interest rates in response to Trump's tariffs, and New Zealand's truck movements indicate a sluggish recovery. That's coming up in our 5 Things in 5 Minutes on Friday, April the 11th. And then in today's bonus deep dive interview, ANZ Group Chief Economist Richard Yetzinger analyses yesterday's pivot by the Trump administration to pause those global tariff hikes.
The markets will just want to see some deals. That will be the key thing. Maybe a Vietnam or an India or somewhere where maybe there's a bit of underlying sense of goodwill.
But first, in 5 and 5 with ANZ, gold was the safe haven of choice overnight, jumping nearly $100 an ounce to a new record high of $3,193 an ounce. This came as US stocks and the US dollar fell sharply, along with oil prices, as reality set in over the extent of Donald Trump's pivot yesterday. They ignored lower than expected US inflation data and a pause in Europe's retaliatory tariffs overnight, instead looking ahead to the effects of the White House's ratcheting up of its trade war with China. There was also a nasty surprise from the White House, which confirmed that its tariffs yesterday actually increased the total tariffs on imports from China to 145%, rather than the previously stated 125%. Here's ANZ Head of G3 Economics, Brian Martin, on why markets ignored a surprise 0.1% fall in the US Consumer Price Index overnight in March, when a 0.1% rise had been expected.
Markets are now squarely focused on what impact higher tariffs are going to have on US inflation going forward, and with very high tariffs in place on China at the moment, and with a 10% universal tariff going on to all imports outside of Canada and Mexico, there's still a lot of uncertainty around, and expectations are, I think, that the FOMC is still going to have to hold policy for some time until it gets clarity on what the inflationary impact of tariffs on prices will be. Will it be a one-off increase, or will it be something more persistent?
As of 4 a.m. Sydney-Melbourne time, the S&P 500 was down 4.2%. The Nasdaq down 5%. The US 10-year bond yield was down 1 basis point at 4.38%. The US dollar index down nearly 2%. The Aussie dollar up, though, 1.2% at 62.26 US cents. And the Kiwi dollar up 1.9% at 57.49 US cents. Gold, of course, up at that record high of $3,193 an ounce, and oil also down nearly 4% at $59.89 US a barrel for West Texas Intermediate. Number 2, China's top policymakers met yesterday to discuss additional stimulus measures after Donald Trump's hiking of tariffs on Chinese goods. It comes as March inflation data fell 0.1% from a year ago, which was weaker than expected. ANZ economist Vicky Xiaozhou says rate cuts could be imminent in China.
The continuation of the trade conflict between China and the US is likely to intensify deflationary pressure in China. Despite no details have been released yet, we believe Chinese policymakers would discuss the options for more supportive measures around the stabilizing stock market and boosting domestic consumptions to counter tariff risk. China's People's Daily has signaled that the flexibility to cut RRR and interest rate. We have penciled in an imminent RRR cut with an aim to stabilize the market confidence.
Number 3, the Monetary Authority of Singapore makes its next monetary policy decision on Monday. Amid all this turmoil, ANZ Head of Asia Research Koon Goh expects further easing to a neutral policy stance.
Despite President Trump delaying the implementation of reciprocal tariffs by 90 days, the downside growth risks to the Singapore economy remain. We believe a move to neutral is prudent at this stage in order to provide sufficient preemptive easing for the Singapore economy to absorb any negative impact from the uncertainty emanating from the uncertain global environment. Inflation is no longer a concern for the Singapore economy, as the MAS core inflation has fallen much sharper than expected in recent months.
Number 4, New Zealand's economy does appear to be recovering, albeit sluggishly. ANZ New Zealand Chief Economist Sharon Zollner says an annual lift in heavy traffic movements of 2.3%, despite a monthly dip in March, is encouraging.
It tends to be correlated with GDP in real time, and we did see it dip in the middle of last year a little bit and recover, but it's certainly not breaking above trend, and that's certainly consistent with our expectation that the economy is steadily but not rapidly recovering from the slowdown we saw last year.
Number 5. However, the sluggishness shows through in light traffic movements, which are more closely linked with the state of demand as opposed to production for heavy traffic. That index for light traffic was down 0.4% from a year ago.
The light traffic weakness likely reflects the fact that people are still being very cautious with their spending, including on petrol, and avoiding unnecessary trips to some extent, whereas the steady lift in heavy traffic is quite encouraging.
Sharon Zollner there. Now, in today's bonus deep dive interview, ANZ Group Chief Economist Richard Yetzinger analyses yesterday's tariff pivot by the US administration.
Well, I've been using the word pivot for Trump. I mean, some people use the word kind of put that Trump would protect markets. Obviously, that's proved to be off base. But I did think he would eventually pivot from the blowback from the tariffs. The tariffs announced last week were much bigger than I thought. The market pain then subsequently much more disruptive. But in the last 24 hours, he has pivoted. He upped the ante on China. So the US and China, if you add them together, roughly have a kind of 200% tariff war between each other now. But for the rest of the world, Trump's shifted back to the 10% baseline tariff and has said for 90 days now we have a negotiation period, and if we can't agree, I'll take you all back to whatever the tariff rates were for your economy that I announced last week. So the 90-day clock is ticking.
What should we expect during these 90 days? I guess this is the time frame for doing deals, as the saying goes. So what kind of deals do you think we could see? How would the process even be for agreeing these sort of deals to keep those tariffs low?
Well, it's hard to believe Trump has a conga line of deal negotiators waiting to do these. So I suspect we've got a funnel with a capacity problem at the small end in the White House. The markets will just want to see some deals. That will be the key thing. Maybe a Vietnam or an India or somewhere where maybe there's a bit of underlying sense of goodwill, where the counterpart economy has some obvious tariffs to give up. I think they might be areas where markets will just want to see, yes, there's a deal. Maybe tariffs don't go back to where they were before the recent announcement, but they're not punitive. They're 10% or 20% or something of that order. Make no mistake, tariffs above zero take the world backwards from a globalization perspective. They cost activity and they boost prices, but they don't take us back to scary days of the past week or so.
Talking about tariffs above zero, we still have those astronomical China tariffs. What ongoing effect is that going to have on the world economy, even though we saw this sort of market jubilation on the news of the pause?
Well, the market jubilation reflects the fact we now probably have an outside bound for how bad this could get, and that was what we had over the past week. So we're inside that at least for a while. The China tariffs are a serious issue. You're talking about 1/3 of global production in China, the world's largest trading nation in China, and 1/4 of global demand, the largest single source of global demand in the US. These two really at loggerheads and set into entrenched positions is still a substantial problem. The global economy still looks to be in weaker shape than it was on the 1st of January this year. Not as weak as it did 48 hours ago, but it's still a situation which is likely to mean the way markets are thinking about central banks is still earlier easing than we might have thought a couple of weeks ago, and a bit more easing than we might have thought a couple of weeks ago.
During all this, government debt markets saw some quite concerning moves or developments, including for the US Treasury. What's going to happen now, do you think? UK gilts, those European bonds, but also the US Treasury market?
Yeah, the Treasury market has been a point of discussion, particularly from kind of pointy-headed market people who are talking about all sorts of strange price action. I don't know that we need to get into that. What we can say is if you stand back and look at the US as an exceptional economy, and I think it has been an incredibly exceptional and successful economy, China does crises much better than the US, but nobody does recoveries like the US economy does. I think this administration is eroding that exceptionalism. I think this administration is working against what has made the US so successful, and asset prices. There probably are some implications for treasuries and debt sustainability at the margin there, but also the US dollar is still very, very strong against a range of currencies. That just doesn't seem the right optics given what's going on with the US's underlying fundamentals.
Richard Yetzinger there, speaking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, April the 11th. Catch you next week with whatever might happen to the global economic system over the weekend. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.